Close to $1 trillion was erased from chip stocks in one brutal week. And a Chinese AI model most American investors had never heard of became the market's favorite explanation. The story sounded simple. Kimi K3 was almost as capable as the best American models, but much cheaper and more efficient. If China could get frontier-level intelligence with less compute, maybe big tech did not need to spend hundreds of billions of dollars on AI infrastructure after all. Sell nvidia, sell memory, sell the entire picks and shovels trade. There is just one problem. That conclusion skips the most important number in the entire debate. The investment question is not whether one AI task becomes cheaper. It is whether the number of tasks grows faster than the cost per task falls. And once you look at K3 through that lens, the story becomes much more interesting than China built a cheaper model, so chip demand is dead. My name is Phoebe, and you're watching TradingKey. Today, we are going to separate what Kimi K3 actually achieved from what the market imagined, test the Jevons Paradox with real numbers, and map out where the profits could move next. Impressive, but not magic. Moonshot AI released Kimi K3 on July 17. It is a 8 trillion parameter mixture of experts model, making it one of the largest open weight models ever announced. That phrase matters. Open weight, not fully open source. Releasing weights does not mean Moonshot has disclosed all of its training data, code, or development process. The full weights are due on July 27, with a technical report to follow. K3 activates only 16 of its 896 experts for each token. Think of it as a company with 896 specialists on staff, but only calling the most relevant 16 into the room for each problem. You get the knowledge of a huge organization without paying every employee to attend every meeting. Moonshot also introduced Kimi Delta Attention and Attention Residuals. Their basic goal is easy to understand: reduce the memory and bandwidth wasted on very long conversations. Moonshot says these changes delivered roughly 2.5 times the scaling efficiency of its previous architecture. That is a serious engineering achievement. It is not, however, the same as eliminating compute. On one composite benchmark cited by Jefferies, K3 scored 57 against 60 for a leading proprietary model. You may hear that described as 95% of the capability. Be careful. 57 divided by 60 is 95%, but that does not prove K3 can perform 95% as well on every task. Benchmarks compress coding, reasoning, tool use, vision, and reliability into one score. Real workloads are messier. Moonshot acknowledges that K3 still trails the strongest closed models overall. It also flags sensitivity to long reasoning histories and a tendency to be overly proactive. K3 is not proof that the frontier has been fully commoditized. What it does prove is that the gap can close much faster than the market expected, and that changes the economics of the model layer, the spark and the fuel. Investors had seen this movie before. When DeepSeek shocked the market in early 2025, nvidia lost nearly $600 billion in market value in one session. So when K3 appeared, traders did not wait for a detailed technical review. They recognized the pattern and hit sell. But K3 did not walk into a calm market. Semiconductor stocks were crowded, valuations were stretched, and investors were already questioning when enormous AI capital spending would turn into equally enormous cash flow. The sector had started weakening before the model was released. K3 was the spark. Positioning and valuation were the fuel. That distinction matters. If the sell-off was caused by a permanent collapse in compute demand, buying the dip could be dangerous. If K3 simply exposed how nervous investors already were, then the market may have punished the wrong part of the value chain. To tell the difference, we need to stop comparing headline model prices and start comparing the cost of getting useful work done. A cheap token can still produce an expensive job. K3 is cheaper than many frontier American models. Depending on the workload, its API can cost roughly 30 to 50% as much. That is a real competitive threat to premium model pricing. But K3 is not the bargain bin option inside China. Goldman Sachs estimates its blended API price at around $2.30 per million tokens. DeepSeek's budget offering is closer to 18 cents. On that comparison, K3 is roughly 12 times more expensive. At first glance, that sounds bullish for Moonshot. It suggests customers may pay a premium for better coding, reasoning, and agent capabilities. Some investors are already calling that pricing power. I would slow down there. Price per token is the sticker price. Cost per completed job is the bill you actually pay. Imagine two models writing the same software. Model A charges less per token but needs several attempts and a human to fix the result. Model B costs more but gets it right the first time. The cheaper token may create the more expensive project. A model can also look intelligent on a benchmark while consuming so many tokens that its economic advantage disappears in production. Goldman's analysis contains an important warning. The estimated cost for K3 to complete one benchmark workload rose by roughly 3 times, broadly in line with its API price increase. That means the higher price may reflect a more capable and more compute-intensive product. It does not yet prove that Moonshot has suddenly discovered software-like margins. True pricing power requires customers to stay, usage to grow, and gross margins to hold after inference costs. Until we see those 3 things together, K3's premium is a signal, not a verdict. When efficiency creates more demand. This brings us to the argument chip bulls love, the Jevons Paradox. In the 19th century, more efficient steam engines did not reduce coal consumption. They made steam power economical for more factories, ships, and industries. Total coal demand increased because the technology became useful in far more places. AI could follow the same path. Cheaper inference can move AI from an occasional chatbot into customer service, software development, advertising, healthcare, logistics, and millions of autonomous agents. A lower price can expand the market faster than it reduces the cost of each task. But Jevons is not a magic word. It is a threshold. Suppose a new architecture reduces the infrastructure required for one task by 80%. The number of tasks must grow by more than 5 times for total infrastructure demand to increase. If usage only doubles, total compute demand still falls. If usage rises tenfold, the chip market gets larger. That is the equation investors should be watching: efficiency multiplied by volume. Jefferies highlighted strong growth on OpenRouter. Weekly traffic rose 12.6% to 52.6 trillion tokens, while Chinese models grew 17.7% and moved ahead of American models on that platform. That supports the broader idea that lower prices and better models are expanding adoption. It does not prove K3 caused the increase. The measurement period largely predates K3's release. OpenRouter represents only part of the market, and free model traffic can distort the comparison. So the evidence is encouraging for the bulls, but the case is not closed. We need several months of usage data, not one exciting week. More importantly, we need to see whether paid workloads grow faster than the infrastructure required to serve them. Jevons wins only when cheaper intelligence creates enough new behavior. Efficiency moved the bottleneck. Now we can ask the question semiconductor investors actually care about. Does K3 need fewer chips? For a given level of performance, its architecture appears more efficient. Kimi delta attention reduces pressure on the key value cache, a memory bottleneck in long context inference. Activating 16 experts instead of the entire model also avoids wasted computation. But a 2.8 trillion parameter model still has to store, route, and coordinate an enormous amount of information. That requires accelerator memory, high bandwidth memory, fast networking, and expert parallelism across many devices. Moonshot recommends deployments with at least 64 accelerators for serious workloads. Efficiency did not remove the infrastructure. It changed where the infrastructure works hardest. Training demand may become less predictable if better architectures allow labs to reach a target capability with fewer premium GPUs. Inference demand, however, can grow rapidly if K3 attracts developers and autonomous agents. At the same time, that inference may run on a broader mix of nvidia GPUs, AMD accelerators, custom ASICs, and Chinese domestic chip. That creates a more nuanced outcome than K3 is bullish for every semiconductor stock. Total compute demand may rise while the mix, pricing, and profit margin of that compute change. NVIDIA can still benefit if the total workload expands. especially because its software and networking ecosystem remains difficult to replicate. But investors should no longer assume every new AI token automatically earns nvidia the same amount of revenue. Memory and networking may have a different setup. Larger models and longer contexts continue to create pressure on high bandwidth memory, data movement, and interconnects even when the math becomes more efficient. That keeps companies exposed to HBM and networking relevant, although none of them are protected from a valuation reset. Models, platforms, and applications. The most interesting effect of K3 may not be on chip volume. It may be on bargaining power. Bernstein describes leadership among Chinese AI labs as a rotating door. DeepSeek leads, then Jipu, then Moonshot, and another model can take the top spot a few months later. That pace is great for users. It is uncomfortable for model companies. When performance gaps close quickly, customers gain alternatives. API prices come under pressure, developers can switch providers, and the model itself becomes less scarce. The companies building the smartest systems may create enormous value without capturing most of it. Platforms can be in a stronger position. Alibaba, Tencent, Microsoft, Amazon, and Google already own cloud infrastructure, customer relationships, distribution, and payment channels. If models become interchangeable, the platform can choose which one to offer, negotiate lower prices, and keep more of the economics. Applications may benefit even more. A software company does not need the world's best model for every task. It needs a model that is good enough, reliable enough, and cheap enough to solve a customer's problem. Falling inference costs can improve application margins and unlock products that were previously uneconomical. Moonshot is trying to prove it can escape model commoditization. Reports suggest its annualized revenue rose from roughly $200 million in April to $300 million in June. And it is considering a Hong Kong IPO within 6 months. That is meaningful growth. But annualized revenue is not profit. We still need retention, inference cost, and cash burn data. Alibaba reportedly owns around 36% of Moonshot through an earlier investment. If the IPO happens at a strong valuation, that stake could become visible optionality for Alibaba shareholders. Tencent is also an investor, while its own WorkBuddy agent reportedly draws 8 to 9 million monthly visits. The lesson is broader than either company. As model competition intensifies, value can migrate toward whoever controls compute, distribution, proprietary data, and the final customer relationship. What to watch next? So, how should investors position around this debate? For nvidia, AMD, Broadcom, and the wider accelerator complex, watch paid AI workload growth rather than benchmark headlines. If task volume grows faster than efficiency improves, total silicon demand can keep rising. If workloads grow but migrate toward custom or lower-cost accelerators, the market may expand while pricing power shifts between suppliers. For memory companies, watch model size, context length, and inference architecture. Attention optimizations reduce some bandwidth requirements, but huge models and agent workloads can still increase the need for HBM and advanced packaging. The direction is positive only if volume outruns efficiency and supply growth. For Microsoft, Amazon, Google, and Meta, cheaper intelligence cuts both ways. Lower inference costs can improve the economics of copilots, search, advertising, and agents. At the same time, falling API prices can weaken returns on expensive proprietary models. Distribution and product integration may matter more than winning every benchmark. The cleanest scorecard has 3 parts. Watch the cost of completing a real task, not merely the advertised price per token. Watch whether paid usage grows faster than that cost falls. Then, watch where capacity remains scarce. Accelerators, HBM, networking, power, data, or customer distribution. Those bottlenecks tell you where pricing power lives. On the next round of hyperscaler earnings calls, capital spending will matter, but utilization and monetization matter more. A company can keep raising CapEx while earning a poor return. The bullish signal is not simply a larger budget. It is a rising workload, improving unit economics, and customers willing to pay. K3 did not kill the AI trade. My conclusion is not that the chip sell-off was completely wrong. Valuations were stretched, positioning was crowded, and K3 raised a legitimate question about how much compute the next generation of models will require. But the market's first reaction was too simple. K3 does not prove that AI needs fewer chips. It proves that intelligence can become cheaper, faster than many investors expected. Whether that hurts or helps the semiconductor industry depends on what happens next, how quickly usage expands, which hardware serves it, and who captures the savings. The model layer may lose scarcity, the infrastructure mix may shift, platforms and applications may gain bargaining power. That is not the end of the AI trade. It is the beginning of a harder phase where buying anything connected to AI is no longer enough. The winners will be the companies that own the bottleneck after intelligence gets cheaper. Do you think K3 makes the chip sell-off a buying opportunity, or is this the first sign that AI infrastructure spending has gone too far? Tell me in the comments. I'm Phoebe with TradingKey, and I will see you in the next one.